Welcome back, everyone. This week saw inflation numbers come in calmer, but market nerves stayed elevated as political pressure around the Fed grew louder. It set a tense backdrop where confidence, not just data, became the real driver. This chart shows the disinflation story in one glance, but it is not a clean victory lap. Headline CPI cooled more as energy and goods pressures eased, while core CPI moved down more slowly and stayed stickier. That gap matters because core inflation is the part policymakers tend to trust more when they talk about underlying pressure. By late 2025, both lines are clearly off the 2020 peak, but the core trend still signals that the last mile is harder. That is exactly why the market cannot treat rate cuts as automatic, even when the headline looks calmer. Now look at what the bond market is doing with that information. The two-year yield is basically the market's live vote on the Fed path, and it can whip around when expectations shift even slightly. The 10-year yield adds another layer, because it also reflects longer run growth and inflation risk, plus the term premium investors demand. When credibility headlines flare up, you often see that nervousness show up here as volatility, not just in stocks. So even with inflation cooling, the rates market is telling you the confidence premium is still fragile. Big headline indexes took a step back this week, but the tape was not a full risk-off panic. Under the hood, smaller names held up better than the mega-cap crowd, which is classic rotation when traders start sniffing out fragility. Defenses caught a bid while parts of tech and the high flyers felt heavy, and you could almost see people hiding in plain sight. The message: breadth matters right now, because when the leaders wobble, the whole market suddenly feels one bad headline away from a bigger slide. We are still paying for the 43 days federal shutdown, and it is messing with the scoreboard. The Labor Department said the October employment report could not be fully produced because key surveys were interrupted, so traders are flying with a blind spot and more revision risk. That kind of data fog makes every inflation print and every Fed headline hit harder because there is less clean confirmation underneath. In a market this jumpy, uncertainty itself becomes the catalyst. The consumer has not rolled over, but the tone has clearly shifted. Spending is still holding up, especially around the holidays, yet households are becoming more selective and value-focused. It is resilience, just without the excess confidence of earlier cycles. This chart is a reality check on the consumer, and it shows the story has not cracked yet. Real consumption growth is still positive, and it broadly tracks real disposable income instead of running way ahead of it. That is a healthier setup than past cycles, where spending kept sprinting even when income could not keep up. Quick note, this official real consumption series updates with a lag, so the latest read is through September 2025. Retail sales are a monthly survey-based snapshot of what stores and restaurants sold, so it is a faster pulse on spending than the broader consumption data. It is not the whole economy because it misses a lot of services, but it tells you if shoppers are pulling back right now. And in the latest print, the pace is a bit lower than the prior month, which fits the same message: consumers are still spending, just more carefully. The first week of earnings season arrived, and the market treated it like a stress test for lofty expectations. Results were mixed, and price moves showed investors were rewarding clear beats and punishing any wobble. But the big question was bigger than any one company. Can profit growth justify high valuations, especially in the parts of the market that have led for months? Let's break this down. The tone was cautious, not euphoric, and guidance suddenly mattered as much as headline numbers. Beyond the data, policy headlines kept risk traders on their toes. Trade tensions stayed in the spotlight, with fresh friction around deals and tariffs in the sense that rules could shift quickly. Add in louder geopolitical talk, and the market had another reason to stay defensive around the edges. Now, here is what matters. When policy uncertainty rises, investors demand a bigger cushion, and that can cap rallies even in a strong tape. Now zooming in on SPY, the ETF tracking the S&P 500, and this chart sets the emotional tone for the entire market. The long-term picture still shows a golden cross context, telling us the primary trend remains bullish even after the recent hesitation. At the same time, price continues to hold above the 50 days moving average, a quiet but powerful signal that dip buyers are still defending key levels. But here is the tension: the 20 days moving average is accelerating higher, which often shows strong momentum, yet also raises the risk of short-term exhaustion. This ties back to the broader mood of the week, confident on the surface, but with traders increasingly aware that the margin for error is getting thinner. Stepping forward from the big picture, this chart highlights SPY extending its close streak above the 50 days moving average, a classic sign of steady institutional support. That level has acted like a magnet all week, with buyers consistently stepping in on shallow pullbacks as inflation headlines stayed manageable. The message here is simple: trend support is still respected, but price is hugging it closely enough that any macro shock could test those hands fast. Looking deeper into momentum, the trend strength signals on SPY are still firmly confirmed, telling us this move has real muscle behind it. That said, indicators are flashing a market that is strong but increasingly crowded, especially after a week packed with inflation data and policy noise. The takeaway is clear: buyers are still in control, but the trade is no longer cheap or relaxed, and nerves can creep in fast if momentum slips. Zooming further into the short term, this view shows the 20 days moving average on SPY accelerating higher, a classic late-stage momentum signal. That kind of slope often reflects urgency from buyers chasing strength after a volatile macro week, but it also compresses the room for mistakes. The market still feels optimistic, yet the speed tells us traders are leaning forward, not sitting back comfortably. Shifting focus to QQQ, the ETF tracking the Nasdaq 100, and the tone immediately feels more intense. The longer-term chart still sits in a golden cross context, confirming that big tech leadership has not broken despite the recent choppiness. What drove this over the past week was familiar fuel, strong expectations around earnings and steady risk appetite even as rate uncertainty lingered. But here is the edge to watch. QQQ is leading the market higher, which usually excites momentum traders, yet also makes this part of the market the most sensitive to any disappointment. Under the hood, QQQ trend strength remains confirmed, showing that upside pressure has not cracked despite the recent stall. Momentum is still positive, but positioning feels crowded after traders leaned heavily into tech following relatively calm inflation data this week. That combination keeps the tone bullish, yet slightly uneasy, because leadership names tend to react first if sentiment turns. But here is the twist. This chart shows a short-term MACD signal cross-turning down on QQQ, hinting that momentum is starting to cool. That does not mean the trend is broken, but it does signal hesitation after a strong run. In a market this confident yet jumpy, even small momentum shifts can trigger fast rotations and sharp intraday reactions. Switching over to DIA, the ETF tracking the Dow Jones Industrial Average, the story is a clean rising trend channel, not a wild momentum chase. It has been riding inside that channel for weeks, which tells us buyers keep stepping in on dips and sellers keep capping the upside in a very orderly way. Here's what the picture really says. Price is close to the upper rail, so upside is getting tight, and any further push needs real fuel. But there is still more room down to the lower rail than up to the top, so a pullback can happen without breaking the trend. The takeaway is calm strength. DIA is trending higher, just in a controlled, grindy way that reflects confidence without euphoria. Drilling into support behavior, DIA continues to hold its close streak above the 50 days moving average without much drama. That tells us buyers are active but not emotional, favoring consistency over momentum chasing. In a week filled with policy noise, this kind of price action signals quiet confidence rather than speculation. Taking it one step further, trend strength on DIA remains confirmed, reinforcing that this index is grinding higher without losing structure. The move reflects steady participation from defensive sectors as investors balance optimism with caution during a noisy macro week. It is not flashy, but this kind of persistence often anchors the broader market when leadership elsewhere starts to wobble. Over in small caps, IWM, the ETF tracking the Russell 2000, tells a very different emotional story. The long-term golden cross context is still in place, confirming that the broader uptrend has reasserted itself after last year's choppy reset. What stood out this week was renewed appetite for domestic growth plays as easing inflation fears and resilient consumer data pushed investors down the risk curve. Small caps are moving with confidence again, but they also tend to exaggerate both optimism and fear, making this corner of the market especially sensitive going forward. Digging into the short-term action, IWM has been holding a strong close streak above the 50 days moving average. That kind of behavior shows buyers stepping in quickly, especially after last week's burst of optimism around growth and domestic demand. It keeps the tone constructive, but also hints that small caps are starting to run hot if the pace continues. Wrapping this up for small caps, trend strength on IWM is still confirmed, but the move is starting to look stretched. Momentum indicators point to strong participation, yet they also suggest overheating risk after a fast run higher. In a market this optimistic but alert, small caps can stay strong, but they are often the first to feel pressure if sentiment cracks. Shifting gears into crypto, Bitcoin, the largest digital asset by market value, immediately changes the emotional temperature. So, this chart shows Bitcoin rebounding within a broader death cross context, meaning the recovery is real but still happening inside a damaged longer-term structure. Over the past week, price stabilized as risk appetite held up across equities, reinforcing Bitcoin's role as a sentiment mirror rather than a safe haven. The bounce looks constructive, yet it lacks the clean trend confidence seen in equities, keeping traders alert instead of euphoric. This is optimism with a helmet on, not blind risk-taking. So, digging into trend strength, Bitcoin momentum has stabilized, but remains fragile beneath the surface. The signals show improvement compared to the prior sell-off, yet they still reflect hesitation as traders wait for confirmation from broader risk markets. This keeps crypto in a cautious recovery mode, participating in optimism without fully committing to it. Zooming out to the bigger cycle, this chart shows how long Bitcoin has gone without a deep 10% pullback, and that tension is building. Extended stretches like this often reflect confidence, but they also raise the risk of sharp resets if sentiment flips. In a market that feels optimistic yet alert, crypto remains the asset class most likely to exaggerate the next emotional swing. Switching from crypto to the US dollar, this chart is the market's global thermostat. It is a trade-weighted index, meaning it tracks the dollar against a big basket of currencies, weighted by US trading partners, and it updates on a daily basis. Right now it is hovering around the 120 area, basically choppy and range-bound, with the latest point a bit firmer than mid-summer. The key takeaway is simple. A steady to strong dollar quietly tightens the world because it makes global funding and imports feel heavier, especially for companies and countries that borrow in dollars. So even when stocks look fine, the dollar can be the silent force that keeps risk-taking on a short leash. After the US dollar segment, gold steps back into focus as a classic pressure valve for macro stress. The GLD chart shows a trend that remains structurally intact, with price holding above key moving averages and momentum still supportive. Money flow staying positive signals ongoing accumulation rather than distribution. This tells us gold is still being treated as a strategic hedge, not a short-term trade. Even with choppy risk sentiment, buyers have not stepped aside in a meaningful way. But zooming in, the tone becomes more cautious. On the RSI, price pushed to higher highs while momentum failed to confirm, forming a clear bearish divergence. That is a classic signal that upside pressure is weakening beneath the surface, even though price itself is not broken down yet. It does not signal an immediate reversal, but it raises the odds of consolidation or a corrective pullback. And you can spot a similar bearish divergence on the MACD as well, even if it is less pronounced than on the RSI. Momentum is still positive, but it is clearly no longer accelerating, reinforcing the idea that upside strength is starting to fade rather than expand. Next up on the calendar, the market focus shifts from charts to catalysts. The coming days put inflation updates and growth signals back in the spotlight, right as confidence feels steady but fragile. With earnings season ramping up, even routine data points can move markets faster than usual. This is the phase where expectations meet reality, and that tends to amplify reactions in both directions. The mood stays cautiously optimistic, but the calendar reminds everyone that complacency can disappear fast. To close this out, today's tape was the definition of calm tension. Stocks are holding near highs, but the bond market is still tightening the screws. Leadership remains concentrated in big tech, and that can keep the rally alive, but it also makes the whole market feel brittle if sentiment flips. Volatility staying low is supportive, yet it is also a warning sign because shocks tend to hit harder when everyone is relaxed. Going into next week, the three pressure points are yields, earnings guidance, and headline risk around trade and geopolitics. The playbook is disciplined optimism, stay constructive, but keep risk tight and respect any break of key support. Catch you next week. Until then, stay sharp, protect your downside, and don't let one headline shake you out of your plan.